Imagine a future where discovering life-saving drugs isn't this decade-long, multi-billion-dollar gamble, but instead it's a systematized, almost industrial process, driven by artificial intelligence. Can an algorithm truly unlock the deepest secrets of human biology and create the next generation of medicines faster, more effectively than ever? Today, we're diving deep into a company at the absolute forefront of this audacious mission. And, well, what we uncover about its current value and future trajectory might just surprise you. We're talking about Recursion Pharmaceuticals, ticker symbol RXRX, trading on NASDAQ. Our analysis is current as of today, July 21st, 2025, with a reference share price of $5.84 from back on July 18th. And you might be wondering, why Recursion? Why is it particularly interesting right now, especially for a pre-revenue biotech?
That's a great question. And it's definitely a stock getting a lot of attention. What we're seeing today, for instance, is Recursion's stock showing significant pre-market strength. It's up over 5.5%. Now, this isn't just some random market fluctuation. It feels like the culmination of really positive sentiment. And that's stemming from a key strategic move they made earlier this month.
Okay, let's unpack that then. So the primary driver for this investor enthusiasm, it was Recursion's acquisition of full rights to the REV-102 program. That came from Rally Bio on July 8th. Now, okay, to someone maybe not deep in biotech, you might think a preclinical asset. I mean, a drug still in very early lab testing, not even in human trials yet. You wouldn't think that would cause such a stir, right? But for Recursion, this was seen as a major de-risking event. How so?
Yeah, it's all about validation. If we connect this to the bigger picture, the market isn't just excited about REV-102 itself. I mean, even though it originally came from Recursion's own AI platform, which is interesting in itself, the true excitement, the real insight here for investors, is that this acquisition is a powerful validation of their core technology. Management deciding to bring this asset fully in-house, an asset born from their own data, their own insights. Well, that signals a strong vote of confidence in the platform's ability to consistently generate valuable and, crucially, de-risked assets. And in biotech, de-risking is huge. It means reducing those massive unknowns that plague drug discovery. So this implies the true value isn't just in one promising drug candidate, it's in the industrial scale engine itself, the engine that discovers these drugs.
Right. And this positive sentiment, it's kind of amplified by a growing macroeconomic trend we've seen all through 2025, which is this increasing investor interest and capital, frankly, flowing into AI applied to healthcare. Plus, maybe some recent market structure developments, like expanded overnight trading that might be enhancing liquidity and just drawing more eyes to these sort of on-trend stocks like RXRX. So our mission today is to cut through all that noise, dive into the specifics of Recursion, and help you understand whether it's a speculative gamble or maybe a ground floor opportunity in a really rapidly evolving sector. We've got 7 key chapters to guide us through this deep dive. Let's begin with Chapter 1, the Recursion thesis. Industrializing drug discovery. So what exactly is Recursion Pharmaceuticals? They operate as a clinical stage tech bio company, founded back in 2013 with a pretty grand mission: decode biology to radically improve lives by, well, industrializing drug discovery. That's a big claim. How do they actually go about doing that?
They've adopted a really unique dual-pronged business model. It's designed to balance risk and reward, which you absolutely have to do in this capital-intensive field. First, yeah, they have their own internal drug pipeline, like any biotech pipeline. That's inherently high risk, high reward. But then, and this is really key, they have crucial collaborations and platform licensing agreements. And these are with major pharmaceutical companies like Roche and Bayer, giants in the field. These partnerships generate significant non-dilutive capital, essentially cash that doesn't come from issuing more stock and watering down existing shareholders.
Okay.
And maybe even more importantly, these collaborations offer powerful external validation, proof basically that their platform works, or at least that big pharma believes it might. They've already secured over $450 million this way. It's an approach that really mitigates that sort of all-or-nothing risk you often see in traditional biotech startups.
That's fascinating. So the product, it isn't just a single drug. It's something much broader. And this is where Recursion really seems to be shifting the paradigm. Their core offering is this entire system they call the Recursion OS. Think of it like an integrated full-stack platform specifically for drug discovery. How does the system work on a practical level, though? What are they actually doing?
It's truly an industrial scale operation. It's pretty amazing. The Recursion OS includes these automated wet labs. They're capable of running millions of biological experiments every single week.
Millions a week, wow.
Yeah, and these aren't just small tests. They're generating this massive 21 petabyte Recursion data universe. that contains trillions of searchable relationships. It's an almost unimaginable amount of proprietary biological data.
21 petabytes.
And to process all this, they actually own one of the world's most powerful supercomputers. It's dedicated to this task. This whole engine then fuels a diversified internal drug pipeline. Initially, they focused on rare genetic diseases and oncology. Cancer, for example, they have a key program, REC-994, that's in phase 2 clinical trials for a rare brain condition, cerebral cavernous malformation. And REC-2282, that's in later stage phase 23 trials for neurofibromatosis type 2. It's a genetic disorder that causes tumors. Then, their significant acquisition of Exscientia in late 2024 dramatically expanded this pipeline. It added over 20 new programs and increased their potential milestone payments from partnerships to over $20 billion.
$20 billion. Potential milestones.
Potential, yes. But that sheer operational scale, millions of experiments per week, petabytes of data that genuinely sets them apart as a leader in this emerging tech biospace.
Okay. So if we distill this down for, for someone looking for the efficient knowledge here, their primary value proposition is fundamentally disrupting traditional drug discovery, which, let's face it, is notoriously slow, incredibly expensive.
And fails over 90% of the time. It's astonishingly inefficient.
Exactly. So Recursion aims to make it faster, cheaper, and ultimately more successful, using this unbiased data-first AI approach that theoretically learns and improves over time. How does this fit into the broader market? What's the industry trend we're seeing?
That's a crucial point because we're seeing an accelerating, I'd say almost inevitable, adoption of AI in biopharma. It's creating what some people call step function shifts in healthcare. This is a massive tailwind for a company like Recursion. It positions them right at the forefront of a pretty fundamental industry transformation. It's not just a niche trend. It feels like a real change in how drugs will be discovered.
But they're certainly not alone in this space.
Yeah.
Like, the competitive landscape has got to be intense. You've got traditional pharma companies building their own internal AI capabilities. And then there are other dedicated tech bio players like Relay Therapeutics, Schrödinger. They're also making strides. So what's Recursion's real differentiator? What makes them stand out from that crowd?
I think Recursion's key differentiator is the sheer scale of its empirical data generation. This isn't just, theoretical computational modeling based on existing literature. It's anchored by one of the world's largest proprietary biological data sets generated from their own high-throughput wet lab experiments. That empirical data, now combined with the precision chemistry capabilities they got from acquiring Exscientia, that creates a unique, potentially defensible position.
This sounds like uncharted territory in some ways, though. The regulatory pathway for drugs discovered by AI, it's still pretty nascent, isn't it? Creates what some people have called a regulatory gray area. Because some algorithms operate like black boxes, meaning it can be hard to trace every single decision step, or how an AI actually arrived at a specific drug candidate. That must pose new challenges for regulators trying to understand how a drug was designed.
Absolutely. It's both a risk and, frankly, a significant opportunity for a pioneer like Recursion if they can navigate it effectively.
And the barriers to entry here seem incredibly high. It's not just about having a clever algorithm, is it?
No, definitely not. It's a synergistic combination. You need the massive proprietary data, the integrated automation, the computational infrastructure, all built painstakingly over a decade. A new competitor would face monumental challenges trying to replicate that whole ecosystem. Plus, their brand is actually quite strong now, boosted by those high-profile partnerships with giants like Roche and NVIDIA.
Right.
The Recursion OS itself creates powerful economies of scale. They can generate data at a much lower cost per experiment than traditional methods. And those major pharmaceutical partnerships, they create powerful switching costs and network effects. As partners deeply integrate their R&D workflows with Recursion's system, it can lead to long-term, potentially high-margin revenue streams. But their ultimate economic moat, the thing that truly protects their business, is that self-reinforcing flywheel system. More experiments generate more data, which refines their AI models, which in turn leads to better experiments, better drug candidates. It just keeps getting better theoretically. That makes them exceptionally difficult to replicate.
Okay, that makes sense. Let's move on then. Chapter 2, Management Evaluation. At the helm, you've got co-founder and CEO, Dr. Christopher C. Gibson. He originated the core vision for Recursion. He's guided the company from being a university spin-out all the way to a publicly traded leader, securing those transformative partnerships we mentioned. Beyond him, who else is driving the ship? What does the team look like?
Well, the leadership team is certainly bolstered by some top-tier talent. People like Dr. Najat Khan, who previously held senior R&D roles at Johnson & Johnson, huge experience there, and Dr. David Hallett, who came over from Exscientia, bringing deep expertise in AI-driven chemistry. What's really indicative of disciplined leadership here, I think, is how management responded during that challenging 2022 macroeconomic environment. Remember how tough that was for growth stocks?
Yeah, brutal.
They prudently pulled back on growth and hiring to conserve capital, but critically, they did so without compromising their long-term strategic vision. That's a sign of a team that can execute under pressure and prioritize the long game, not just short-term survival.
They also seem to maintain high transparency. And CEO Chris Gibson, he's built a strong ethical reputation through his broader involvement in the life sciences ecosystem, like founding Altitude Lab, which is a biotech incubator. What about their capital allocation strategy? How are they spending the money they have and raise?
Their strategy seems crystal clear. The overwhelming majority of capital gets reinvested directly back into R&D and expanding that Recursion OS, building the core engine. M&A, mergers and acquisitions, has also been a cornerstone of their growth strategy. But these seem like highly targeted moves to build an end-to-end platform. They've acquired companies like VM, Cyclica, Valence, and of course that landmark Exscientia deal. Each acquisition looks strategically chosen to fill a specific gap or enhance a capability within their system. It wasn't just growth for growth's sake.
Now, as a pre-profitability, high-growth company, naturally, they have no history of dividends or share buybacks. That seems entirely appropriate for a company at this stage, right? All capital needs to go into building the business and its competitive moat. But how does that reflect in traditional financial metrics like return on invested capital, ROIC?
Yeah, it leads to a deeply negative return on invested capital, currently somewhere around minus 48% to minus 57%. Now, for a traditional mature business, that would be alarming. It would indicate really poor capital efficiency.
Right, red flags everywhere.
Exactly. But for a company like Recursion, it reflects the immense upfront investment required to build that competitive moat we talked about, the integrated platform, the proprietary data, and to fund their extensive, expensive clinical trials. So the investment thesis for Recursion isn't about today's negative ROIC. It's really about the potential for an extraordinarily high positive ROIC, maybe a decade from now. If their OS succeeds in truly industrializing drug discovery, it's very much a long-term play.
Okay, let's transition now to Chapter 3, Financial Analysis. Let's dive into the raw numbers. Recursion's current market capitalization is floating around $2.53 billion. The revenue, which, as we said, primarily comes from those collaboration agreements, it's what you'd call lumpy, unpredictable timing. But it is growing. It increased from $44.6 million in 2023 to $58.8 million in 2024. That's a solid 31.8% increase year over year. And analysts are projecting continued growth, even accelerating perhaps to over 50% in 2026.
However, and this is the big however,
Yeah.
as we just discussed, and as is totally typical for a clinical stage company investing so heavily in R&D, they are not profitable, not even close. Their profit margins are deeply negative. For instance, their net profit margin for the trailing 12 months, that's the last 4 quarters combined, was around minus 961%.
Wow. Minus 961%.
Yeah, it's an expected characteristic of their business model at this stage. R&D expenses just vastly exceed the revenue coming in, and these metrics will undeniably remain negative for the foreseeable future as they continue to invest heavily in the platform and the pipeline.
And they are definitely in a significant cash consumption phase, burning cash. For the trailing 12 months, their free cash flow was approximately negative $397.7 million, almost $400 million burned. This high cash burn rate, it's really a central element of the bear case against the stock, and it's a critical metric for you, the listener, to monitor very closely. Our sources show their operating losses and cash burn have increased pretty consistently year over year from 2020 through 2024.
Yeah, that trend is clear. But despite the heavy losses and cash burn, there is a significant financial strength here, and that's their exceptionally low reliance on debt. Their debt-to-equity ratio is very conservative, only 0.10. They haven't loaded up the balance sheet with debt.
Okay, that's good.
And they also maintain a robust short-term liquidity position. Their current ratio is a healthy 4.11. That means they have more than 4 times the current assets needed to cover their current liabilities. This provides substantial financial flexibility and ensures they can comfortably meet near-term funding needs without immediately having to resort to debt or, rush another share issuance.
When it comes to valuation, then, traditional metrics like the price to earnings, the PE ratio, they're just not meaningful because of the negative earnings, no E. but their price-to-book ratio, currently around 2.54, is actually below the industry average. That might suggest they're valued reasonably on an asset basis, what their physical and intellectual property is worth on the books.
Potentially, yes, on a book value basis. However, look at their price to sales ratio. It's very high, around 35. What does that tell us? A high price to sales ratio, like 35, reflects the market's extremely high expectations for substantial future revenue growth. Massive growth baked in. It indicates investors are willing to pay a big premium today for every dollar of current revenue because they're anticipating a huge increase in sales down the line.
Right. Which makes sense given the potential disruption.
Exactly, but it also raises that important question. How do you value a company like this intrinsically, given all these factors? A discounted cash flow, or DCF, analysis. It's exceptionally challenging and highly speculative for a clinical stage biotech company. The output, the final number you get, is extremely sensitive to assumptions that are just incredibly difficult to predict accurately.
Like what kind of assumptions?
Things like clinical trial success rates. Will the drugs actually work? The timing of drug approvals, when will regulators say yes, and potential market share, how much of the market can they capture? Tiny changes in those assumptions can lead to wildly different DCF values.
Right. So our educational DCF model, which we kind of calibrate using Wall Street analyst price targets. And remember, those targets range widely from $4 all the way up to $10.50. Our model suggests a very wide intrinsic value range, too, approximately $4 to maybe $9.50 per share. It's really not about pinpointing a precise current value. It's more about understanding the probability, the possibility of achieving a much higher value if their platform truly succeeds.
Exactly. And the key assumptions driving even that wide range include things like a multi-stage revenue growth projection, assuming they eventually get products to market and ramp up sales, assuming they eventually reach significant biotech operating margins, but that's probably a decade or more away. And crucially, you have to use a very high discount rate in the model, typically 15% to 20%, maybe even higher. That's to account for the extreme risk profile inherent in a company like Recursion at this early stage of its commercialization journey.
Okay, we're now moving into part 2 of our deep dive. Let's kick that off with chapter 4, market sentiment. So the Wall Street analyst community, currently they have a hold consensus rating for Recursion, not a buy, not a sell, but hold. This seems to reflect that mix we've been talking about. Long-term optimism about the platform's transformative potential, but also definite near-term caution because of the substantial clinical and financial risks we just covered. And as we mentioned, the price targets are all over the place, $4 to $10.50. That spread really highlights the level of uncertainty in the market right now.
Yeah, uncertainty is the word. Interestingly, the general media tone surrounding Recursion tends to be predominantly positive. It focuses on the exciting AI revolution in healthcare, their high-profile partnerships, especially the one with NVIDIA, which gets a lot of attention.
Right, the AI angle is hot.
But, and this is a critical, maybe often overlooked market indicator here, Recursion has an exceptionally high short interest. Over 28% of its publicly traded shares, the float, are currently sold short.
28%. That's huge.
It's massive. This represents a very large, well-capitalized bet against the company. And it's driven primarily by concerns about their significant losses and that accelerating cash burn we discussed. The bears are focused on the financials.
That extreme positioning, with so many shorts, it creates what traders call a coiled spring dynamic for the stock, doesn't it?
Absolutely. A large short position makes the stock highly vulnerable to a short squeeze. If any significant positive news hits, say, a surprisingly successful clinical trial result or a big new partnership, those shorts might scramble to cover their positions, buying back shares, which pushes the price up rapidly.
But the flip side.
The flip side is, conversely, any negative news, a trial failure, a setback, could lead to a sharp decline as those short positions gain conviction and maybe even add to their bets. It truly is a battleground stock. You've got strong bulls betting on the future and strong bears betting against the current financials.
Technically speaking, how does it look?
Well, the current stock price, around $5.84, is trading above its 50-day moving average, which sits at about $4.89. That's typically seen as a bullish short-term signal indicating some recent positive momentum. However, it's still trading below its longer-term 200-day moving average, which is up at $6.24. This suggests that while the recent momentum is positive, that longer-term bearish trend from earlier periods hasn't been definitively broken yet. A sustained move above that 200-day level, that $6.24 mark, will be a really key technical test for the stock's future direction. Bulls want to see it clear that hurdle.
Got it. Next up, Chapter 5, ownership structure. Who actually owns RXRX? Recursion's shareholder base is overwhelmingly dominated by institutional investors. Big money. They hold a commanding 68% to 71% of the outstanding shares. And this includes major players known for their long-term, growth-oriented philosophies. Names like ARK Investment Management, Vanguard, Bailey Gifford, BlackRock. For you, the listener, this is generally seen as a powerful vote of confidence. These are sophisticated investors who typically do very deep research into disruptive potential before taking large stakes.
Yeah, that institutional backing is significant. And what's particularly insightful, I think, is that company insiders, including the CEO Chris Gibson, they maintain a significant ownership stake themselves, around 4.14%. This is important because it directly aligns their financial interests with those of public shareholders. They win when you win, essentially.
Makes sense. What about recent insider activity? Buying or selling?
Recent insider activity has largely been what are called acquisition, non-open market transactions. These are typically things like RSU grants, restricted stock units, which are a common form of executive compensation, rather than insiders actively buying or selling shares on the open market. So while not active buying, the lack of significant open market selling can often be interpreted as continued confidence in the company's long-term prospects.
And the ownership overall, is it spread out or concentrated?
It's fairly concentrated. The top 13 shareholders control over half the company. Now, this means decisions by a relatively small number of large funds can significantly impact the stock price, both up and down. But again, it also indicates that professional investors, those with a deep understanding of the business and presumably high conviction, are heavily invested.
Okay, moving on to Chapter 6, risk assessment, SWOT analysis time. Let's start with the strengths. We've touched on these. Their pioneering technology platform, that proprietary data moat. It gives them a first-mover advantage that seems extremely difficult to replicate. They have a strong financial position, relatively speaking, with robust cash reserves and low debt. Plus, those high-value partnerships with industry giants like Roche and NVIDIA.
And the visionary, experienced management team we discussed earlier, definitely a strength. But this inevitably raises the important question: what are the limitations? The weaknesses inherent in their current position? Well, the most obvious one is the lack of profitability and that very high cash burn rate. That means they will almost certainly need additional financing down the road, which usually means dilution.
Right, issuing more stock.
Exactly. Their commercial success is also still entirely unproven. No drug discovered by their platform has actually made it all the way to market yet. And their current revenue stream is heavily dependent on those unpredictable partnership milestones. It's not steady, recurring revenue.
Okay, weaknesses noted. On the flip side, what are the opportunities? The opportunities look massive, frankly. Their platform is designed to be disease agnostic, meaning, theoretically, it can target a vast addressable market across many different disease areas, not just one or two. Future partnerships could potentially be even more lucrative than the ones they already have. And their strong balance sheet, that cash pile, it positions them well for further strategic M&A if the right opportunities arise.
And don't forget, for traders, that extremely high short interest we talked about, that creates the opportunity for a significant short squeeze on positive news. It's a double-edged sword, but the upside potential is there.
Sure. Now for the threats, the big risks.
Well, the biggest threat for any biotech company is always clinical trial failure. It's the elephant in the room. A major failure in a key program, like one of their phase 2 or phase 3 candidates, could severely damage the entire investment thesis. Confidence could evaporate quickly.
Yeah, that's the binary risk.
Exactly. They also face intense competition, not just from other AI-driven companies, but increasingly from the internal AI efforts of large pharmaceutical companies who have massive resources. There's still that regulatory uncertainty for AI-discovered drugs we mentioned. How will the FDA and other agencies handle these? And given their high cash burn, future shareholder dilution from issuing new stock seems not just possible, but highly likely to finance their ongoing operations and clinical trials.
So what does all this mean for you, the listener, considering the broader economic climate? Well, inflation directly increases their operating costs, salaries, materials, everything. That just accelerates their cash burn. And higher interest rates. They disproportionately reduce the present value of those distant future cash flows that the whole valuation relies on. It also makes it more expensive for the company to raise capital, whether through debt or equity. So the current high-rate environment is a significant headwind for a long-duration growth stock like Recursion.
Yeah, definitely a headwind. And if we connect this to the bigger geopolitical picture, There's talk of proposed U.S. tariffs, potentially 25% or even higher, on imported pharmaceuticals and raw materials like APIs.
APIs being the active pharmaceutical ingredient.
Correct, the core chemical compounds of drugs. If those tariffs happen, they could disrupt Recursion's global supply chain because research materials often come from overseas. This would inevitably increase the cost of essential research materials and add further pressure to their already high cash burn rate. It just makes their path to profitability even more challenging.
Okay, lots to consider that. Let's bring it all together. Chapter 7. Conclusion. So the investment case for Recursion Pharmaceuticals. It's really a long-term bet on a fundamental paradigm shift in drug discovery. You're not just investing in a single drug candidate here. You're investing in a potentially scalable engine designed to industrialize the entire discovery process. They possess, arguably, a formidable competitive moat built on their proprietary data and integrated system. They have a fortress balance sheet for now with lots of cash and low debt, crucial industry validation from those high-value partnerships, and high-conviction ownership from growth-focused institutions and insiders. That's the bull case in a nutshell.
However, the bear case is equally compelling and grounded in the harsh realities of biotech and early-stage technology development. It is fundamentally speculative. The AI platform's actual ability to consistently overcome that notorious 90% clinical failure rate in drug development, it's still unproven in the real world with marketed drugs.
Right. The proof isn't there yet.
Exactly. Their cash burn is immense and, in its current state, unsustainable without future capital raises. That almost certainly means further shareholder dilution down the line. That extreme short interest represents a large, sophisticated, and convicted group betting against them, primarily on those financial grounds. There are those binary risks from clinical trial outcomes, huge swings based on data readouts, and the macroeconomic headwinds, like high interest rates, are particularly punitive for long-duration growth stocks like RXRX.
And as we discussed back in the financial analysis, any attempt at an intrinsic valuation for Recursion at this stage is highly uncertain. It's more art than science. Our educational DCF model suggests a very wide range, roughly $4.50 to $9.50 per share. Lots of room for interpretation.
Yeah. The current share price, around $5.84, falls within the lower middle portion of that estimated range. Look, Recursion isn't a traditional value investment. You're not buying earnings or dividends here. It's much more like a venture capital style opportunity playing out in the public markets. Very high risk, but also potentially very high reward. The ultimate success or failure won't be determined by the next quarter's earnings report. It's going to be determined by management's ability to translate their impressive technological prowess into tangible, clinical, and eventually commercial success over the next decade or so. The journey will likely be extremely volatile. Expect big swings, but the potential upside, if they actually execute on this vision, is truly transformative.
So the question for you, the listener, to mull over is this. In a world increasingly driven by AI, how much are you willing to invest in the promise of industrializing the very discovery of life-saving medicines? Knowing the immense risks, the unproven nature of the core thesis in practice, and the long, likely bumpy road ahead. That wraps up our deep dive into Recursion Pharmaceuticals. We hope this exploration helps you feel truly well-informed on this fascinating and certainly controversial company. If you found this deep dive valuable, make sure to like and subscribe to the Stock Analytics AI YouTube channel. Remember, members get priority deep dives on tickers, and over the next few months, we're actually covering all of the S&P 500 stocks with exclusive priority access for members. If you just want a one-off deep dive on a specific stock, drop us a super thanks. We do look at those requests.
And a final, very important note. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Knowledge is most valuable when it's understood and applied wisely.
Thanks for joining us for this deep dive. Until next time, keep learning.